Okay, in this video, we're going to talk about leasing. And we're not going to get into a lot of detail about leasing in general. We want to just describe what it's all about, right? So leasing, I think most people understand that leasing is an alternative to buying. So if you buy an asset, you own it, you depreciate it, you maintain it. At the end of its lifespan, you can decide what to do with what's left over. If you lease something, you don't own it. So you don't get depreciation, you get lease payments. And of course, those are all deductible as an expense. Now at the end, kind of depends on what the lease is all about. But most of the time, at the end of the lease period, the asset is returned to the lessor. So there's really just two choices. Which one is the least expensive? Which one is the most economical and provides the most benefits? Again, either way, you get the asset. It's how the asset is managed and used operationally that makes the difference. So the lessee, that's the person that's getting this asset. The lessor is the person that owns the asset and is going to receive the lease payments. For the most part, there's very little payment up front for leases. And again, we have to decide at the end of the lease, based on the lease agreement, what happens to the asset at the end of the contract term. So we have something called a sales type lease. This is the lessor makes or manufactures the product or the asset, and they then lease it out to the lessees. A direct lease is where the lessor is not the manufacturer, but they're like the dealer, if you will. So what they do is they purchase the asset and then they lease those assets out to customers. If you kind of think about any of the rental places, maybe around your home, right, where you can rent an asset, this is essentially a direct lease. Now we could have something called a sale and lease back. In this case, a company has an asset that they own, but they don't want to own it. They would rather be leasing it than owning it. So they sell the asset to the lessor and then lease it back. Why would they want to do that? Most of the time they do that because of it could be the debt situation that they're in. They could be in a cash flow challenge. Lots of reasons why you might want to do a sale and lease back. A leveraged lease is when the lessor borrows from the bank to buy the asset and then leases it out. And these last two are just separate kinds of special types of leases. We have a separate business partnership is created by the lessee just to obtain the lease. So this is created, maybe it's an additional division or segment of the company is created just to take care of the lease itself. And a synthetic lease, again, it's designed to obtain accounting and tax treatments in a special way. So the idea with leases is that it creates challenges with understanding the leverage of a company. And this is why companies sometimes will lease. They don't want to borrow money because it shows up as debt. So they lease. But does the lease show up as a leverage? Usually the lease, it's not an asset, it's not a liability, right? So, I mean, it is a liability, you have to make payments. But in this case, it doesn't show up as a debt, right? If you borrowed money, then obviously you own the asset. It is on the books as an asset and it's on the books as a debt. So it's how the company wants to address and deal with the tax situation is what typically drives these leases. So how do we determine the payments? So there's something referred to as the residual value or the salvage value. So in this case, we'll say, look, we think that at the end of 4 years, this asset is going to be worth $6,000. It costs $20,000 today. So the lease payment is what's going to equalize, if you will, this time value question. So the present value of the lease payments has to equal the purchase price minus the present value of the residual value. So we could do that with a time value question. Here's this example. If we assume that it's a risk-free interest, right, risk-free exchange, they have a risk-free rate, 6%, 4 years, monthly payments. You plug in the future value, which is a positive $600. The present value is $20,000 today. So if you look down here, the payment that pops up is this $358.79. That is what the lessor will charge for this lease. Another way to look at this is, what if you borrowed instead of leased? Well, the present value of the loan payments have to equal the purchase price. So here we have negative 20,000 is the price. We have to find the loan payment that's going to equalize or complete this time value question. If the loan's fairly priced, with a standard loan, the entire cost of the asset is financed. With leases, though, only the cost of the economic depreciation is financed. So what that means is that the cost of loan payments will always be higher than the lease payments. But what do you also get? If you're making loan payments, if you own this asset, you also get to depreciate the asset as well. So here we have again this example, right? So we can do this either with the payment or a loan. You'd use the time value of money, or you could use the time value loan analysis worksheet. And you see here that the payment ultimately comes out to be $469.70. So if you borrowed the money and purchased it, it would cost you $469 a month. That's principal and interest together, remember. And then if you leased it, it would only be that $378. So by the law of one price then, these things have to be equal. The present value of the lease payments plus the present value of the residual value have to be equal to the present value of the loan payments. Now, this is in a perfect market, of course. And what we've talked about perfect markets is there's nothing in the world that's perfect. So again, we're going to be close. We have to do the analysis to understand what is best for the company to do. So that's the end of this quick video on leasing. I look forward to seeing you in the next video.